Is inflation back? This is the question that everybody's asking around the world, whether you're a trader or an investor. And with the NASDAQ falling for 3 days straight and yields absolutely skyrocketing, if we break some key points, we're in for some capitulation. Hello, ladies and gentlemen, and welcome back to The Daily Show. We discuss stocks, commodities, and cryptos together. Today, we'll be deep diving into the S&P 500's fall. It got to the level we discussed in the last video, but now will we bounce? The 20 moving average might hold the key. Also, the biggest stock in the world, it fell big time, and it happened right where we discussed it in the last video. But more importantly, I think we need to talk about yields, because this and oil is what everybody's talking about. Well, welcome back, everyone, to The Daily Show. We discuss the macro, lead indicators, and of course, the hottest charts for everything that you've been watching on the charts recently. If you like anything to do with markets, make sure to subscribe because we'll be covering it every day like we always do. Let's begin with a bit of a cross-section of what happened in the last 24 hours. Yes, the biggest stock in the world fell 3.58%. Nvidia, also one of the hottest stocks, fell 3%. And we saw Tesla fall a little bit more and then rally into the close. So what does that mean for the stock? That and more coming up in today's show. But let's discuss something I shared over on X or Twitter, and you can follow in the links in the description down below. And that's the bullish percent index. I just want to bring it up because we've seen this play out before. And more importantly, we haven't usually seen what we tend to do, which is a capitulation on a bear bust. Whenever we see nice corrections, usually the market will sell off aggressively, freaking everybody out, and then rebound fairly quickly. We certainly got a rebound, but we didn't see the bullish percent index do much more than usually just a little bit of a dead cat bounce. So basically a false rally. Is that true? Is this indicator helping us again? I'll be updating over on X to make sure that we're always on top of this over the next couple of weeks. So make sure to follow us there. Let's also talk about stats. We know we're in the weakest month of the year, and I think that we've covered that quite a few times. I'm pretty sure everybody knows this by now. The question, though, is with a post-Labor Day week, let's say we end closing bearish, will we get a pre-OPEX bullish week? Traditionally, yes, 30 to 20, remember, is the stat towards bulls, but it's the post-OPEX week that I want to think about. What happens then? Well, if we break down most of the post-OPEX weeks, you can see here that Wayne Whaley's gone through and he's broken down over 50 years of data to really tell us what goes on in September, and more importantly, how the September 19th to 26th run is the worst. Have a look at these stats and some of these data points. You can see that generally, if it's going to be a really bad sell-off, it's somewhere in the vicinity of 3 to 4%, and usually not much worse. If that did happen at certain points in the future, it's possible that we could hit a 4,200 or even 4,150 on the market. And I know the bears would certainly be cheering that point. But for the bulls, it's not quite over yet. And you'll see when we go through the charts later on in today's video why that could be. So let's now take a look at why bulls should be maybe a little bit happier with the stats. Of course, when you have a super positive year to date into August, even though August was weak and September may still be weak, remember it's only a 75% stat here, negative 3.5 is possible, then we usually go to a 100% win record. Don't forget, most of the selling for September tends to occur based on 1950 to 2022, so over 70 years of data here, all the way near the end, the post-OPEX or post-quadruple witching event. That tends to be when we see that sell-off. For longer-term investors, you're always looking at certain metrics, and here's one from JP Morgan, which of course is the forward PE. We're sitting around 18.6 at the time of this recording, and we're nowhere near the average, which is still on 16.77. Imagine if we hit 4,200 though. Considering some of the upgrades some stocks have gotten, I'm pretty sure we'll be getting close to that average, and I'm sure a lot of buy the dip buyers would be very excited by a level down here. This is a bit of a chart showing you what's happened over time, but as we get into these 19s and even 21s, you know we're starting to top off usually in terms of where investors find fair value. We have hit bigger ones before though. Back in March of 2000, we hit a 25.2 times forward PE. We will update you on the sentiment. I've already had some guesses coming in from everyone in the community. I guessed that we were going to go towards a 35 to 36% bullish read this week, and the bears would go down to somewhere around 31 to even 29. and most of you have got your guesses in. So we'll see who's winning, but basically we will have this report in our next video, and that will give us a bit of an idea of whether Wall Street has potentially trapped bulls into this recent rally or not. Now, yields is what everyone's discussing. So why do we need to pay attention to yields? Well, of course, liquidity stress index is very important. I'd say this is spiking back up again. We'll get an updated chart on this soon. But more importantly, when we see yield going back above 5%, 5.1%, especially the US 10-year approaching new all-time highs, we've tended to see something break. Will that be the case? Well, it has been in the past, and I always believe that if we get a new high on US 10 years, something is breaking in the system, and I'm sure we're going to find out about it in due course. Let's discuss now dark pool liquidity before we get into the options and the chart discussion. And dark pool liquidity helped us a little bit to try to figure out that this rally so far might have had a dip in it. Basically, we saw a lot of large funds potentially placing short positions on what we call leveraged or slightly weird ETF zones. Now, we've had this a few times before. The only problem is, did they just close their position? There were some shorts the other day that came through on the Qs as well with Ultra Pro shorts, and this is SQQQ, and there's quite a few other positions they've gone through. But we saw a nice here dark pool sweep, number 86, so a fairly large volume coming through. Is this further confirmation of shorts, or are we about to reverse? The price action here is going to be very interesting, because if this was them taking profits, it's possible they do go in short and sharp and look for these kind of quick moves. But if that's them getting ready for another kind of bust down, expect this thing to explode, and of course for us to pressure equivalent on the SQQQs of 1950. That's going to be where they're defending the next zone. The next 24 hours, and in fact the next 2 days of trade, are going to be very interesting for all of us. Another one is everyone's discussing energy, but at the same time that we're discussing energy, we're seeing some large trades at previous XLE peaks. So this is the sector for, of course, energy stocks. I think there's a little bit of profit target taking happening here, but it doesn't mean that energy's run is over, and we'll show you that on the charts a little bit later in terms of spot. Let's now move over to the wonderful world of options, which we always take a look at every day. And it looks like Zoom continues to really represent. We mentioned that in the last 24 hours, and he put another decent day together, 1% with some unusual options activity, 1.29. And I've taken a look at the charts, and I've got to say, they look pretty damn good. 18,955 calls. Everyone was stacking puts, but guess what? It went up. Yeah, I think that the charts actually present a lot better, and I'm surprised everybody was trying to go against this stock considering how good it looked. Everyone's still piling into iShares Silver Trust as well. This is not going well for most people. 2.1 times the average 90-day volume. You can see here there's a big battle between the bulls and the bears in terms of volume, but overall the day was pretty close to a standard day. 51% puts though to 49% calls. So the bears were more active in the options market than usual. A lot of the time we're looking for calls to continue getting ramped as the market's coming down to show us that there's more room for further selling. As we know, this week can be very lackluster. Next week tends to be more bullish. So if we're looking for bears to really take control of this market, we're looking for them over the next 48 hours. Then next week, maybe a little bit of a relief rally. And then, of course, post-OPEX week, that'll be very interesting indeed. Now, why are we kind of thinking, oh, maybe there could be some sellers? Well, the first time in a little while, we finally saw some defensives doing okay. Utilities, staples, and healthcare, although they weren't up on the top, they were close to the top. GDX also, gold and financials and energy, so some inflation-based trades as well, were holding firm at the high, with basically regional banking getting smashed the most. This has to do with some liquidity questions that we will be answering in our weekend video. We also know here that energy stocks are starting to do pretty well over 5 days. In fact, they've been doing well for a while. Metals also have been doing well over the last couple of weeks. We've talked about iron ore many times, but it brings us to a 5-day average for semiconductors to actually be down 0.03%. I bet most of you did not know that. Staples here, healthcare, utilities, still absolutely horrid. We're looking for those to really get ramped up if this is going to be a proper sell, and that just has not happened. The rotation just doesn't seem to be there from the street. Let's jump into the charts. Let's take a look now at what everyone's talking about. And first off, it has to be yields. I mean, US 2-year yields, take a look at this one, 5.0%. We've gone back above 5. And you would have thought this was not going to happen. We did not think that 5% was going to be hit again after we started to see it down here. But then, of course, it reversed instantaneously. Now, 5.1 becomes the big limit. When the market goes into the unknown, markets freak out. That brings with it capitulation. If you remember what we talked about at the start of today's video, we talked about the bullish percent index. Usually we do see some kind of capitulation on markets, and we already know that markets don't like the fear of the unknown. So if we hit past 5.1%, that could be a very big trigger for markets and especially sellers. Take a look at this US 10-year as well. So I had set alert, actually this should be at these highs here, and we're looking for a break and close above 4.33. If that happens, again, the fear of the unknown on the US 10-year, it's going to have dramatic ramifications. If you're a gold trader though, you do not want this thing above 4.33%. That's going to be very bad for gold, at least temporarily, although we do remain bullish on the metal in some kind of weird stagflation that we could be going into, or even a rate cut environment in the future once we've done these last couple potentially rate hikes that could be there from the Fed. We don't know yet. Of course, we might think it's just pivoting. We have no idea at this stage. Treasuries. Now, treasuries have tons of issuance. So we've warned against this being the low. I know everyone's talking about it being the low. I don't think it is. I'm not sure, but I certainly haven't seen a trade change of any kind of movement yet. Yes, we got a bit of a relief rally, but we didn't go through 97.50, and that to me means that we haven't put the low in just yet, at least on the charts. So what are we looking for? Well, 88.90 seems still likely for treasuries, and we'll be paying close attention to the charts as we move forward. The VVIX, this is the volatility of the volatility, continues to spike up. A good sign for the bears and obviously a bad sign for the bulls. Basically, if the volatility underlying is starting to spike, it means that people are getting freaked out ahead of, guess what, inflation. So this could be like a sell the rumor by the fact. Inflation numbers are coming next week. I think it's like Tuesday or Wednesday. We'll look at it at the end of the video. And basically, when those numbers come out, we are going to have that volatility spike, and then probably it'll compress straight away. But in terms of people freaking out, that seems to be what's happening here. We went down. Let's have a look at this on a non-line chart for a second. Go candles. We didn't quite get to our 12.12 for the VIX, but yes, the volatility of the volatility is spiking, and that's something we're watching. We also saw a big sell-off here of stocks, or percentage of stocks above the 20-day moving average. Now, this spiked a little bit higher than we wanted it to. Of course, usually when you're getting these kind of fake rallies, they're usually pretty fast and sharp, and they don't usually get above this red line here unless they're real rallies. Now, we did get above this red line in this case, the 20 moving average here, and then we sold off. Now, of course, if we go to a new low, well, we'll already be capitulating at that point, but something to watch here. And also keep an eye on percentage of stocks above the 50-day moving average, because that didn't quite hit what a normal rotation of a sell-off was, which is to move back below kind of into that 20 to 25% of stocks above the 50-day. That's usually where you're starting to see a potential low for markets. Let's now move over to the skew. The skew got crushed again. Good for bears. We've talked about this quite a few times. And then we'll move into metals. So basically, we're looking at the metals. And still, everybody that says that China's going down and everything's terrible and everything like that, well, I say let's look at the copper market and look at the metals markets in general, and particularly iron ore, which is heavily, used, of course, in their economy. It's not falling, guys. This is still a very strong price for iron ore. And if you noticed, when the media got most negative on China, all of a sudden, what did we see? We talked about Vale, we talked about BHP, and we got nice 4, 5, 6% spikes on some of those stocks on the way up. So it just shows you that sometimes the reality of what the price is showing you and what the storylines are telling you is completely different. That's not to say there isn't some severe sickness in that country in terms of the property market. It's bad. We'll see what happens soon. But we do expect something to go on in October. And I think the market's kind of pre-prepping itself for this. Let's move over to the US dollar. It's on its way towards our targets, which is 105.16 to 105 kind of 20 zone. And it almost reached it over the session. But yeah, that was a super strong rejection here. And the US dollar just keeps pushing up and up and up. We've talked about it in previous videos, and we still think it's probably going a bit long. Gold's holding itself, but for gold spot traders, I do have a little bit of a concern. We are going into a weakness period for gold traditionally. And remember, if yields do break out to new highs, it's going to be a problem. So 5.1% and 4.35 on the US 10-year. Not going to be good for gold. We'll need to be watching it very closely. For gold stock traders, it held itself. So it actually held exactly where you wanted it to. 28.50 was achieved. We ended up closing at 28.47. So if it's going to be the bulls coming into